Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bill's back again, another year and another podcast.
Well, I stumbled at the start, Andrew, because it's a new year, it's 2023, and I was going to interject something like that in there, but we're back for the year after the summer break.
Exactly right. Back for another podcast and still going.
That's it. Still going strong. Episode number 71.
71. Wow, it's gone quick.
Has gone quick, absolutely. And Andrew, what are we talking to everyone about today?
Yeah, so first one back today, new year. And I know this is now our first episode that we've posted, but this is the first one that we're recording for 2023. So we figured that a really great topic and, something that's worthwhile talking about is talking about what you need to do in 2023 to set yourself up financially. To make sure that, at least financially speaking, it's a successful year.
Yeah, and I think that's really relevant and timely considering what we're going through at the moment with cost of living pressures. Obviously, interest rates are increasing as well. That may be getting slightly better. We'll talk about that in a sec, but I don't think it's going away necessarily anytime soon.
Exactly right. So today, we're talking about all of the things that you can do personally when you're, looking about the financial decisions that you're making on both a day-to-day basis and a long-term basis. But we're also taking a lens of what's happening in investment markets and what's happening with, interest rate increases and inflation, and really trying to make a, informed decision as to what it looks like and what 2023 is likely to pan out like, and how you can set yourself up in that regard.
Sounds good. Let's get cracking.
Yeah, look, you've already touched on kind of the biggest one and the thing that's really going to move the dial for, a lot of people, and that's the cost of living. Cost of living, we're talking about inflation. You and I were talking yesterday about how much the grocery bill was and how much it's gone up so dramatically over time. But sort of adding to that, the RBA has been increasing interest rates, and that was happening for really almost 3/4 of the year last year. It's been a pretty hard time for household budgets.
Yeah, and I think expense management and budgeting, and I know that we've been talking about this a lot recently, and I guess when times aren't as challenging or as difficult as they are now from a financial management perspective, it's one of those topics that we probably don't talk about and engage as much to people when we're having conversations around, financial advice, financial planning, wealth creation. But at the moment, that seems to be the core of it. And, we need to really lean into that, because that's the key. If you can't control your budget, or if you're not as tight on things as, you could be, it's very easy for those big external factors to have a really big effect and a really big impact and kind of knock you off course.
Yeah, absolutely. And I find, it's one of those things that, as you said, when times are good, like let's say you're looking at your household budget, you've got, a 10 grand a year surplus, then you're thinking, all right, everything's great. I've got 10 grand a year I need to invest. And for most people, it's not what you should be doing, but for most people it's, all right, fantastic. This is what I've got to play with. They're not looking for that extra, 5 grand a year and how to make it 15.
Yep.
It's only when times get tough and that, that number goes from 10 grand a year to negative 10 grand a year that you think, all right, I got to find something, because going backwards is not going to be the right course of action. So expense management, budgeting, cash flow, we've done, multiple podcasts on it in the past, but making sure that your financial house is in order before you consider any of the other stuff, and, what we're going to talk about to some degrees, maximizing the opportunity and making the most of the current situation financially. But before you embark on any of that, expense management, budgeting, clear idea on cash flow. Like that is key.
That's crucial. I've actually got an example that I reckon will work really, really well here, and trying to take a positive out of the increasing cost of things. So during the week, I met with an existing client and we were talking about the increasing interest rates on their mortgage and the impact that it was having from a cash flow perspective. And the household income is quite healthy. The household surplus before the interest rate increases was very healthy. Because of the increases and the size of essentially their mortgage, that's starting to get eroded. And what that's done is it's led to us going through a budget and a cash flow exercise. Now, previously, because their surplus was so healthy, there was almost this unconscious spending, and they weren't really paying, not necessarily not paying a lot of attention to it, but it was one of those things that they didn't have to worry about because it wasn't smack bang right in the middle of their world. Obviously, things get tighter at the end of each month. Maybe the money's not available, or the surplus isn't as big as what they're used to. So they've recognised this, they've seen it. We've gone through a budget and a cash flow exercise and picked out a few things that they can concentrate on. And it was really surprising to them where they're actually spending some of their money. So from that perspective, this was a really positive outcome for them because it gave them that focus that I think everybody needs to run the magnifying glass over their household budget and their expenditure and what's happening. And really great scenario, we could tweak a few things and, basically try and eliminate that leakage that was happening in the budget and their spending and really developing some positive habits around that now. So there's a positive that came out of that.
Yeah, absolutely. And I guess the key to all of this is you do it now because you're kind of forced in a position where you have to pay attention to it. And hopefully those actions and that mentality carries on forward, even when, things do normalize to some degree. And from a cash flow perspective, it's positive. Hopefully you've been through that exercise. You've set up the structure and you've set up everything so that, when times are good, the structure's still there and you're still maximizing that surplus as much as you can.
That's it. We're talking about individuals and household budgets and things. I think it's also relevant to point out sort of self-employed as well too, because that's critical for business owners as well.
Yeah, absolutely. I mean, you consider the cost of business, and it will vary depending on what business you're talking about. But generally speaking, the cost to business and business being able to operate, their expenses have increased. So you consider, when unemployment levels are at such historical low levels, you're now needing to pay more in order to be able to attract staff.
Yeah.
Your, supply chain issues are still not fully resolved post-COVID if you're in, any form of import or manufacturing or anything like that. And so as a result, making sure that not only, you're doing everything you can from a personal budget perspective, but also from, your business perspective, if you're self-employed, if you've got control over that, making sure that the budget from a business side of things is tight is really important as well.
Yeah. Yep. No, well said. Property, interest rates, that's, other than the budget, that's where my mind is going with this.
100%.
I guess we're right in the thick of it in terms of our own personal circumstances, but what we're talking to people about a lot of the time in the current environment seems to be the impact of the variable rate that's having on their cash flow, and what do they do from that perspective. Look, I guess it's fair to say that you don't sell in this type of market unless you have to.
Yeah.
So we probably want to make an assumption that, you're not going to sell. What are some of the things that we should be focusing on? What are some of the things that we need to be doing in this particular type of market when it comes to property, and in particular in an interest rate environment that at the moment still seems to be increasing? We'll wait and see what happens in the February meeting, but that'll be interesting whether the Reserve Bank decides to go 25 basis points or if they decide to sit. Time will tell. I think it's an even split between the economists who are putting some numbers out there and stuff, but it seems to be, I think, a 50-50 split between 25 points and 0.
Yeah. Look, I think for the most part, the expectation is that we are going to see some form of interest rate rises this year. There's going to be something to combat inflation, and taking into consideration what the US does as well is going to make, or US inflation as well is going to make a big impact to that. But when you know that interest rates are going to rise, and they already have been rising, again, it's coming down to expense management. But the other thing that's also sort of key for a lot of people in all of this is fixed rate periods. So have a look, know exactly when your fixed rate home loan is going to come out of fixed and move to variable. And it's not a difficult thing to do, to at least try and estimate what it's going to be. You can either contact your bank and they should be able to tell you, once you do move to a variable, this is going to be the rate, this is the estimated repayments. Or alternatively, if you want to estimate it, quickly and easily, there's online calculators, which will be able to estimate your repayments based off, some assumed factors. You know what your fixed rate is, but assume a variable rate once that switches off to fixed. Match the loan amount, the loan term, and just play around with the change in interest rates once that happens, so that you can expect it and so that you can plan for it. Because one of the things that we're also going to talk about is potentially the impact of property prices once those fixed rate home loans convert over to variable, and once people start feeling the pressure from an interest rate perspective, the impact that may have on property prices. You don't want to be in the camp of having or being forced to sell while interest rates are, or because of the fact that you haven't accounted for interest rate rises.
And really the calculation that I'm thinking when you do talk about that is really, well, the impact is really twofold. I think first and foremost, it's understanding the cash flow requirements, and it's not necessarily just for people going from fixed to variable, although that will be a fairly big shock. Because the fixed rates that were locked in were quite healthy, 2%-ish, versus a variable rate of probably 5.5% at the moment. So that jump will be quite dramatic. But for people who are on a variable rate, we're still seeing increases coming through and they're still expected. So what I'd be looking at really is twofold. Firstly, the cash flow ramifications of a higher interest rate, and then how does that tie into your budget, your income, your expenses, and what does that look like? Try and get a determination of, are you still in positive territory from a cash flow perspective, or are you in negative territory? That's probably the first thing. If you're in positive territory, that's fantastic, because that's a position that you want to be in. If you're in negative territory, what are some of the things that you can work and tweak in your budget to try and get to a surplus? And then above and beyond that is have a cash flow, have a savings buffer that if you needed to, because your cash flow is in deficit, you can actually dip into that. And then how long does that support you for before you need to take, some other action around what that looks like? So really getting an estimation of your position, getting really clear on, a couple of different scenarios and saying, if it does this, this is how long it's going to last for us. And just get a better indication of what your scenario may be or what your situation may look like with some numbers around that. That's really how I'd be thinking about it. And then if it looks positive, if it looks negative, at least you've got that information. At least you're armed with that knowledge, knowing, okay, regardless of what happens, I'd say we're kind of good for the next X amount of months. 12 months, 6 months, 3 months. If it's a distant time in the future, fantastic. If it's a short period of time, it's an indication that you've got to take action immediately, and it might be that you reach out to a professional to have a chat too, but better off starting that sooner rather than later. But you really need to go through that exercise to determine and find out what your position is.
Yeah, so burying your head in the sand is not going to be the solution.
Most definitely not. No, you've got to be proactive about it.
Yeah, exactly right. And the next conversation is ultimately really, what's going to be the impact, or what is not what's going to be the impact, what's likely to be the impact to property prices should some of those things come to fruition. And look, it does depend on suburb, it does depend on the property, there's a huge range of factors, but, largely property prices have come off a little bit, not a huge amount, depending on area. But when people are forced into a position where they might need to sell, so you'll know from our last podcast when we spoke to Galan that there's been kind of a bit of a standoff between buyers and sellers, purely because people that are discretionary sellers, so don't have to sell their property, are holding off. if you're a discretionary seller, you're not wanting to sell in a period where there's uncertainty.
Yep.
Once or if discretionary sellers do not become discretionary and they now need to sell their property because there's, cash flow implications or because there's something that has caused them to have to sell those properties, we may see some more properties come onto the market. Once that supply and demand equilibrium starts to shift, all of a sudden the expectation is that, there may be some further decline in property prices, which can represent an opportunity. If you've, been sitting on that savings buffer, if you've got that deposit that's been there, on one side, you want to avoid being in that boat and you want to avoid being the person that's being forced to sell. But on the flip side, you want to be the person that's, got all your ducks in a row and is able to maximize and take advantage of the opportunity. So one of the other, real consideration for investors over the next 12 months is what happens with property prices. Have I been waiting and sitting on the sidelines to either upsize or purchase an investment property? Is now a good opportunity to buy into property and take advantage of the circumstances that we're in? Yeah,
and I guess with every sort of market cycle, there's different opportunities, there's different threats. It just depends on what sort of camp that you're sitting in. But absolutely, I think we're entering into a period where we will see opportunity, and if you're in the right position, it's definitely an interesting time to consider, hey, is the timing right for me to be able to pull the trigger on this and go for it? And I think in particular, there's probably two things that come to mind from my perspective is upsizing your property. So it could be owner occupier and wanting to, move into something a little bit bigger because your family's expanding, or if you want to upgrade the type of property that you're living in, or potentially the suburb. That springs to mind. And the other thing is obviously naturally the investment property. And what's happening with rentals is quite interesting at the moment. But that really springs to mind that if you're in that position, if you've got a solid financial foundation, if you've got the ability to borrow, if you've got, decent and consistent and secure income streams, you've got good savings, you're starting to tick a lot of those boxes. So even if you are making a decision in a market that is volatile, but an opportunity presents itself, at least you can go into, and you've got a long time frame to invest, you can go into it with a degree of confidence, knowing that, hey, I'm buying it during a period of market volatility, but it's a long-term investment. I've got all my ducks lined up, my financial position's secure and I'm comfortable. Bang, I'm going to go for it. I actually think that we're entering in, for those people that are in that position, I actually think we're entering into a really good period of opportunity for them. Yeah, absolutely. And so on the flip side of that, it's probably not the best time when you're considering the downsizers. So people in the other boat whereby, you're wanting to sell a more expensive property and buy a cheaper property because of the fact that there's, obviously some disparity in prices and decline in prices. You don't want to be liquidating the more expensive property. So if you can, and if your lifestyle suits, then it's probably a thing to consider that perhaps you should hold off on that decision and maybe do that at a future point in time, or get in on it quicker because your expectation is that the decline is going to happen sooner. I mean, there's any different way that you can view it, but there's definitely going to be some consideration, some movement around the property market, and making sure that you're making an informed decision that's based on rationality and based on your personal situation, not based off fear and wanting to do things super quick is absolutely the right strategy to go down. Yeah, well, I think Alan touched on that last week in terms of property. Like, you're not selling property in this environment at this stage unless you're forced to. And that goes back to people downsizing as well too. But if you're transacting in the same market, there's potentially an argument there for it. But yeah, I tend to sit in the camp that you wouldn't be selling, I should say. You wouldn't be selling in this market unless your circumstances had changed and you had to do it. Andrew, talk to us about investment strategies sort of outside of property. This environment that we're in at the moment, what does it look like for us at that point in time?
I mean, look, investment markets, there's been a fairly large amount of volatility, to say the least, that we've seen sort of throughout the course of 2022. At least the start of 2023 looks like it's going to be in a similar vein. There are going to be ups and downs, and knowing which way the market is going to go, it's a futile discussion. I mean, and that's the honest to God truth is every single day I'm sitting in front of clients, and every single day clients are saying, what's the market going to do? When are we, do we buy, do we sell the whole portfolio and leave it in cash? And that, represents another element of massive risk. And so the thing that it always comes back to, the thing that is absolutely key in all of this is long-term investment decision making. Make sure that whatever you're doing, you're not overcommitting to. Yes, there's opportunities in certain market segments, and there's the ability to, put additional funds towards certain areas, but provided that that's within your means to do so, and provided that you're not overextending yourself and taking on a huge element of risk. But generally speaking, the start of the year, just because people have a bit more time, it's a good time to look at and reevaluate your investment strategy, reevaluate what you're doing, and make sure that it's right for you. But it's even more important that when you're in a volatile market cycle, that you're reevaluating that and you're making sure that you're getting professional advice on it, because that's what's going to be the difference between making rational and irrational decisions.
Yeah, yep. And it's a long-term investment time frame majority of the time when you are looking at these things. And one of the conversations one of the phrases that I've been saying to people recently, and trying to refocus their thinking around this, because yes, we do get it all the time. What's the market doing? But you can't only participate in the wealth creation game when things are good.
Yeah.
It doesn't work. It's like saying I'm only going to go and play an outdoor sport when the sun's shining and raining, and you can't control the weather, right? I don't know if that was a good one. That just came to mind. But trying to explain the same thing, you can't do it. So what do you look at? You look at your risk tolerance. You look at your asset allocation. You diversify, you dollar cost average, and you take a long-term perspective, and you turn down the noise.
Yeah.
And that's probably a really big one as well too, because at the moment there just seems to be just so much happening absolutely everywhere that you look.
Yeah.
And that's always the way. That's just the way that the world is at the moment. China's population growth is going backwards for the first time ever, I think it is. The New Zealand Prime Minister just announced that she's going to resign. Michael Clark's girlfriend just slapped him across the head. And
now Billy's just pulling out random news topics.
Just trying to think about what I saw on my newsfeed this morning, exactly. Right? So, yeah.
No, but look, you're absolutely right. I mean, there's being involved in investment markets and being an investor and wanting to grow your wealth means that you need to be able to ride the wave, and you need to be able to participate in all market cycles. The general consensus is that when you're participating in markets, you hold it for long enough. Your entry point and exit point are going to be different, and it should be higher than your entry point, your exit point. Yeah. But that doesn't mean that you can avoid all of the ups and downs along the way. So you need to make sure that you're doing it in the most effective manner, because that's also not to say that you buy that penny stock, hold on to it and expect that in 10 years time it's going to be worth more. But you need to make sure that you're doing it with rational decisions, that you're making, decisions based off good quality assets that are going to be around in 10 years time, and adjust your position when you need to. But at the same time, that also means that, when there is some uncertainty, when there is some volatility, that you also don't sell down to cash, sit on the sidelines, wait, and then, as the market comes up, expect to buy back in and, take advantage of the upside, because there's been many people that have tried to do it. I have seen very little to none actually do it successfully. And so making sure that you're, riding that wave, dollar cost averaging, doing all of the right things is absolutely key.
Yeah. And probably the only other little bit on top of that, which all of this, you summarized it really nicely, and it's very, very hard and difficult to do if you don't turn the noise down. But it's just the mindset and discipline piece around this, and saying, yes, I'm going to commit to a certain course of action regardless of what's happening. So the news, the environment can do this, the market can do that. I'm committing to an investment strategy and I'm going to stick to it. And having the discipline and the mindset of turning down the noise and saying, no, I'm going to continue with it. I'm going to be committed, and that's the way and that's the strategy. And that's what you do, assuming that your investment strategy is sound and your financial position hasn't changed from when you originally set it. I think that's the key there. So it's as much of a psychological play as it is an investing play as well too. And that's the challenging part, especially when there's so many bits and pieces moving in the world at the moment. And that's what makes it difficult. And that's what I think forces people to sort of change tact from one direction to the next.
Yeah, absolutely.
Yeah.
Billy, very well summarized. I think, we've done that one justice. We've dusted off the cobwebs from having a little break, and it's been great to jump back on the podcast again with you.
That's it. You too, Andrew, and to our viewers and our listeners, hope you got a whole heap of value out of today's podcast and video recording. And if you need any further information or want to have a chat about your circumstances, we're always here and willing to help out. And we look forward to catching you on the next one.
Thanks again.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.